Hello and welcome to Hard Money. I'm Natalie Brunell. Bitcoin passed the $25,000 mark for the first time since June. Bitcoin's price has seen a bear market rally in the past month, up about 15% as investors see signs that inflation may have peaked and the possibility of a Fed pause. The Bitcoin Fear and Greed Index, which gauges public sentiment on Bitcoin, is also back at neutral for the first time since April. Meanwhile, there's more trouble for embattled crypto lender Celsius. New court documents reveal that the company is in even worse financial straits than previously reported. According to Celsius' own legal team, the bankrupt lender is expected to run out of cash by October and owes about $6.6 billion to customers. Celsius reportedly only has about half of that amount. The most alarming finding in the court documents was its Bitcoin holdings. Celsius disclosed that close to 105,000 Bitcoins were deposited to their network, but the company now only holds less than 15,000. Hard Money has reached out numerous times to Celsius, and each time they declined to comment, only referring us to their website. The SEC is requesting documents from Coinbase over some of its products, including staking. According to Coinbase, the SEC wants information on how Coinbase lists assets, classification of listed assets, staking programs, and yields. In a letter to shareholders, Coinbase says, "This is more of an inquiry rather than a formal investigation." The latest development comes as the SEC is investigating Coinbase for trading unregistered securities and insider trading of one of its former executives. In a previous statement, attorneys for Coinbase say they are confident that all of their practices and processes are in compliance with regulators. Last week, we mentioned that the U.S. Treasury Department sanctioned Tornado Cash and blacklisted several Ethereum addresses. Tornado Cash is a crypto mixer that allows people to maintain their privacy online. Specifically, what the U.S. government did was put Tornado Cash and several addresses on the Specially Designated Nationals and Blocked Persons List, or SDN for short. By being put on SDN, it made it illegal for anybody to use Tornado Cash or transact with those addresses. The Treasury Department says they did this because Tornado Cash was routinely being used by criminals, especially a hacking group with ties to the North Korean government. This action by the U.S. government is raising concerns, though, within the Bitcoin community over privacy rights and sparking questions about whether the federal government stepped beyond its authority. If you're not aware, Tornado Cash is an open source code that is free for anybody to use and not owned by anybody. Its main function is coin mixing. Here's how coin mixing works. If you have a jar, then you and 10 friends each put a quarter into that jar, then shake it up, then you reopen the jar. It's impossible to know which quarter originally belonged to which person in the group. Some Bitcoiners argue banning Tornado Cash is an overreach of authority. In 1996, the federal government established that code is a form of free speech. Similarly, in 2010, the Supreme Court ruled that money is also a form of speech. Seth Hartline, global head of policy for Ledger, argues that these sanctions are most likely in violation of the First Amendment and raise due process concerns. Supporters of the ban on Tornado Cash argue that the blacklist was justified because it was being used by international criminals with ties to countries that are unfriendly to the U.S. But Hartline argues that if the Treasury Department only sanctioned the alleged criminals and hackers, it would be no issue, but sanctioning a piece of code is a step too far. As they say in the Bitcoin community, a knife is still a knife whether it's used by a surgeon or the criminal. Meanwhile, the United Nations is warning countries to avoid embracing cryptocurrencies. The UN Conference on Trade and Development says crypto could lead to risks in tax collection, monetary policy, and financial stability. The agency is advising countries to impose higher taxes on crypto transactions, requiring exchanges to register all wallets with regulators, and banning ads. While the UN is warning against adoption, it appears some countries in Europe are actually embracing it. The Cyprus Securities and Exchange Commission just gave regulatory approval to the digital bank Revolut to offer Bitcoin and other crypto services to the European Economic Area, which includes 27 countries in the European Union, plus Iceland, Norway, and Liechtenstein. This is the first time the Cyprus SEC approved a crypto asset service. Cyprus is trying to become a crypto hub in Europe with favorable laws and regulation, which has also attracted companies like Crypto.com, eToro, and Bitpanda. A new SMS-based service is bridging the gap between Bitcoin and people without internet access. Machankura is an app being used in Africa for people to send and receive Bitcoin without the need for an internet connection. The developer who created the app believes the lack of internet access, especially in the underdeveloped world, is one of the biggest hurdles for Bitcoin adoption. Eventually, Machankura wants to make SIM cards that can work as private keys so people will be able to self-custody. Now let's take a look at some of the big macroeconomic news we're following. American workers are becoming less productive. According to the Labor Department, last quarter saw the biggest drop in worker productivity since 1947. It's unclear what's behind the drop, but most economists are attributing the decline to the pandemic because businesses were forced to focus more on health and safety protocols over innovation. Other economists speculate that working from home also worsened productivity. Some market analysts anticipate we could be seeing more widespread layoffs as a result. And there's more evidence that the U.S. housing market is in a recession. The National Association of Home Builders Index dropped again in August. This is the 8th straight month of decline as builders and buyers struggle with higher costs. The NAHB says tighter monetary policy by the Federal Reserve is having a major impact on people being able to afford homes. And in fact, housing affordability is at its lowest level since 1989. They base this number on a number of factors: household income, mortgage rates, and how much a current house is worth. Affordability is then based on whether they can afford the loan without spending more than 25% of income on payments for principal and interest. While the majority of central banks around the world are raising rates, China recently cut 2 key interest rates to boost economic activity. China has slowed down across the board in July, including factory output, investment, retail sales, youth unemployment, and property prices. There's been growing unrest in several cities in China over high mortgage rates and plummeting property values. Also, 1 in 5 Chinese youth are currently unemployed. That's the highest amount since 2018. China's unexpected move to cut rates may foreshadow further cuts to borrowing costs in the coming months. Those are the latest headlines. Ahead, we speak to investor, analyst, and author Mark Moss for his insights into macro markets and, of course, Bitcoin. Don't go away. Welcome back to Hard Money. Joining me this week is investor, analyst, and author Mark Moss. Mark, thanks so much for joining me on the show.
Yeah, thank you for having me, Natalie. Always a pleasure to talk to you.
Well, I want to get your take on this macro environment. We've seen some equities and Bitcoin rally recently, but the Fed's still trying to fight inflation, hiking rates. What do you see? What do you want us to know?
Yeah, so I guess it depends on what we consider macro and what we consider micro. So, I mean, looking at that, what we can see is since the Fed basically had their meeting back a couple of months ago, we've seen the markets have been rallying. Gold's up about 6.5%. We've seen Bitcoin's up 36%. Nasdaq's up about 36% since about June 17th. So everything's rallying off of that. Of course, we've seen the 2-year and the 10-year both made their peaks around the same time, June 14th, have since come down a couple points, 7%. Et cetera. And so we're seeing this rally. Now, a lot of people want to know, is this a bear market rally? Is this a fake out or is this a real rally? And of course, we won't know until we're looking backwards on it. But I think it's probably real for now. And so if you look at take the NASDAQ, for example, and zoom out, look at a chart from like 2008 till present, draw a trend line, and you'll see that it stayed right on trend. And that looks very impressive. As a matter of fact, one of our mutual friends, Dr. Jeff Ross, the perma bear, I had him on my show and we looked at that chart together plus a number of other charts. And he says, dang, Mark, you might be changing my mind. And so I think this is a real rally. It's not a fake out that we're seeing right now, but I think that's still zoomed in a little bit too far. And so I wouldn't really call that the macro. I think that's more of the micro.
Well, what do you think that the Fed is doing right and what do you think they're doing wrong?
anything the Fed is doing is inherently wrong. Let's just say that all manipulation is bad, in my opinion. And now they're just trying to see if they can help things, but it seems to only make them worse. I think the narrative that we're all following is wrong, and it misleads us to believe what the Fed can do and will do. So what do I mean by that? We're talking about this soft landing. Can the Fed engineer a soft landing? Well, they would assume that the economy, this complex system like the economy, the markets, et cetera, are like this complex fighter jet that has all these different rudders and ailerons and stuff that you can change the direction of this flight plan. And the Fed could somehow masterfully, drive this ship to a soft landing. The reality is that it's more like a blimp, and all they can do is add hot air. That's about all they can do. So there's no hope of a soft landing. I think it's a completely wrong analogy. This thing is so complex. It's gotten so far away from them. They're trying to only just control the air. All right. All they can do is control the Fed funds rate, and they're trying to manage the entire economy made of trillions of inputs. And so I think it's a wrong analogy.
There are lessons to be learned in every single bear market, some hard lessons sometimes to be learned. So what are the takeaways you think in this bear market so far?
Well, I think it depends on the time frame, right? And so what are people trying to understand? What should I do in the next 6 months? What should I do in the next couple of years? What should I do by the end of the decade? And so what time frames? And so in the macro, I don't consider that macro. This is kind of like short term, like what's going to happen in the next couple of months. Can the Fed save us from this giant deflationary crash that some of these, David Hunters or others would declare we're having a Harry Dent or something? We're going to have an 80% drawdown before the election happens, as some of these predictions have been. So can they stave that off? And I think the answer is they probably can, but there's way bigger problems on the horizon. The problem is that, they say generals always try to fight the last war, and they're trying to fight this. They've been, for the last, 250 years, they've been fighting off deflation. So as the world has been globalizing, it's been a massive deflationary force, which has been great. It's allowed them to print hundreds of trillions of dollars. So it's been great. So inflationary monetary system and a deflationary long-term secular trend. And that's because we're offshoring jobs, we're offshoring manufacturing, et cetera. But the world is changing right now. And we're going from a long-term secular deflationary period to now a long-term secular inflationary period. So as this world continues to break apart, as we see Russia and Ukraine situation exacerbate, as we see China, the situation with supply chains, et cetera, we're now reshoring supply chains on the United States, manufacturing, all that's changing. And that's going to be very inflationary. War is very inflationary. More government policies, which we all know we're going to get. It just got passed today. All of that is very inflationary. So the Fed's been fighting deflation. They think they're still trying to fight deflation, but the reality is what they're fighting now is inflation, and it's going to be a much different world than what they're seeing right now.
Well, Mark, I love watching your videos. You've covered so much ground. You talk about the Russia-Ukraine conflict, what's happening in Sri Lanka, energy. What are you tracking right now? What can we expect?
Well, one of the big story that popped up today that I thought was very fascinating, I put on Twitter earlier, was we know that Russia and the BRICS nations, the BRICS, BRICS, which stands for Brazil, Russia, India, China, and South Africa. We know the BRICS nations have been continued to be joined by more and more nations. They make up about 50% of the population of the world. And they've been working on, creating their own associations, coming up with their own currency. They're coming up with their own payment network, like a SWIFT network. But they announced today that they're going to come up with their own gold agency. So we use the LBMA, London Bullion Market. And they want to come up with their own. And the reason why is, as anybody would probably guess, the LBMA is complete manipulation. In the morning, a couple of guys get on the phone and they say, what should the price of gold be today? And I'm not exaggerating it. That's really how it happens. And so you can understand how manipulated that is. And then, of course, a few months ago, there was a story of that billionaire who had that big nickel bet, and the LME reversed it, and he lost, millions of dollars or billions of dollars, however much. And so they understand how manipulated this is. And if Russia and China and the BRICS want to move to this new monetary system that may be backed by gold, as they're saying, then they need to get away from that manipulated gold environment that they're in. And so this move to set up their own LBMA is massive, in my opinion, if they go through with it, which I think there's a good chance they will. They don't just talk, they actually do things. Then what it will do is it'll break the back of the LBMA. What does that mean? Well, it's step one of this evolution that we're in, or maybe it's further along. What happens is first you break the grip of manipulation on the gold asset price, which then continues to break down the fiat money system. Now, we all know that gold failed because of the centralization aspect, right? It lacks one of the main attributes of money, which is portability. And so they'll try to go back to gold to try to get some trust back into the system, and they'll wallow around in that for a while. And then eventually it's just going to push people back to Bitcoin. So I think that's really big news that broke today that most people probably haven't really realized it yet.
Wow. Well, everything's good for Bitcoin, right? While I still have you, Mark, you recently released your book that you co-authored with Alex Svetsky, The Uncommunist Manifesto. Why was now an important time to release that message and write a counterpoint to the Communist Manifesto?
It is a very important time. And I think as we hope it could be the zeitgeist of its time, like it's the right book at the right time. And so I think we're seeing this all over right now in different forms, and people haven't really picked this up, but it's Marxism. Marxism just won't go away. It continues to be reincarnated and just kind of reintroduce itself over and over. And so what we see at the World Economic Forum today, this 2030, you'll own nothing and be happy, is nothing new. This is the same thing that's been fed to us since Karl Marx wrote the original Communist Manifesto. In it, he said, if I summarize communism in one statement, it would be the abolition of private property. And so all of these attacks that we're seeing against the farmers and the fertilizer and you and not eating your red meat, and all of these attacks that we're seeing from everywhere, and just the slogan, you'll own nothing and be happy, is all about Marxism. All of Klaus Schwab's dreams of this stakeholder capitalism. What we're seeing with the fights in the government, we're seeing with the Twitter censors and takedowns of prominent people like Alex Bernstein. Those are all examples of Marxism that just won't go away. And so what we wanted to do is the original book, I think the ideas are really infectious and sticky because they give people justification for their own human or sinful urges, like greed and deceit and laziness and things like that. And so they one, give people justification for that, and two, a plan to go get other people's wealth. And so those appealing to some people. And I think we've really not tried to go back against the book tit for tat, but rather just reintroduce a set of principles that I think encourages people to be better versions of themselves, help build each other up. And we believe a cooperative world is much better than a coercive world. And we hope this book will really help usher that in.
Well, I really enjoyed the read. Mark Moss, thank you so much for joining me. And stay with us here on Hard Money. Coming up, we have a special report on the Inflation Reduction Act. Don't go away.
Oh, hi, I'm Max Patrick. And this, of course, is Plucky. I got a new job. I'm now Plucky's trainer. We're doing some of these sit-ups here. He wants to get as strong as possible for the fiat money apocalypse.
That's right, Max. We're both heading into the fiat money apocalypse, and I'm stacking sats over Swan Bitcoin.
Oh, that's so smart, Plucky. How did you get so smart? Get the Swan app.
Welcome back to Hard Money. This week in our special report, we explore the Inflation Reduction Act, the government's attempt at fighting CPI, passing a massive spending bill. But critics warn it could have many unintended consequences. Take a look.
The motion is adopted.
There you had it. Last Friday, the House passed the Inflation Reduction Act, a sprawling bill that aims to tackle prescription drug costs, global warming, and raises taxes on billion-dollar corporations. Critics say it's really a costly climate, tax, and healthcare reform bill that will ultimately fall short of fighting inflation for hardworking Americans.
Most economists seem to have a consensus right now, and that is that if this bill does indeed become law, it will do very little to bring down the high prices we are all experiencing.
Take a look at this University of Pennsylvania Wharton Business School study estimating that the act would, quote, have no meaningful effect on inflation in the near term, but would reduce inflation by around 0.1 percentage point by the middle of the first decade. These point estimates, however, are not statistically different from zero.
So if you are looking to this to help you with your groceries, your gas, your rent, it's not going to do it.
It's called the Inflation Reduction Act. But the Congressional Budget Office, which is nonpartisan, said that there would be a negligible impact on inflation this year and barely impact inflation at all next year. I mean, isn't it almost Orwellian? How can you call it Inflation Reduction Act when the nonpartisan experts say it's not going to?
So I appreciate that. I appreciate the question. We've actually addressed this, the CBO. It was the top line number. There's more in there that shows that it will have the money remember how we're doing this too. It's making sure that billionaires in corporate America are paying their fair share.
Making billionaires pay their fair share sounds all well and good in a soundbite, but how do you prevent corporations from passing higher costs down to consumers or finding more legal loopholes to avoid taxes? And what's to be said about the fact that Washington's policies help prop up the cantillionaire class whose wealth astronomically expanded during the pandemic-driven money-printing explosion? Critics say Washington just drafted a monumental piece of dystopian eco-legislation.
I mean, we just passed the Inflation Reduction Act here in the United States, which is essentially a way to reduce inflation by printing a bunch of money. And not only that, it's essentially a backdoored Green New Deal.
This bill will cut our carbon emissions by 40% in just 8 years.
Here's what's in the 755-page act on climate. $370 billion to be spent on emission-reducing energy initiatives, including tax credits on purchases of electric vehicles and solar panels. In healthcare, allowing Medicare to negotiate prescription prices for seniors and an extension on subsidies for Americans on Obamacare. And finally, taxes. The bill calls for a new 15% minimum tax on corporations that have incomes of $1 billion or more, plus a 1% excise tax on stock buybacks. Oh, and we can't forget boosting the IRS to the tune of $80 billion and nearly 90,000 new agents.
We are lowering costs, we are fighting inflation, and we are saving the planet.
The legislation faced fierce opposition in the House last Friday with hours of debate, raising red flags from mostly Republicans.
Democrats believe they can spend their way out of inflation and tax their way out of a recession.
Even Bernie Sanders, a socialist who can come up with a million flawed excuses to spend your tax dollars, says he can't find a way to even say this would reduce inflation one iota.
Reject this bill, put Americans first. It is time to vote hell no.
Proponents of the act say middle-class Americans will benefit from the reforms, but critics argue it just kicks the can down the road for the government to spend and control ever more, picking winners and losers along the way.
The biggest winners are regulatory agencies like the EPA and the IRS, Medicare price control, special interest, rent-seeking corporate handouts. This bill has the potential to increase inflation and deepen recession. It will not reduce deficits or debt. The bill has no common sense. This bill is dumb. Very, very dumb.
I'll be honest, I go back and forth between it's a globalist ploy and it's just pure incompetence.
The act also raises questions about how America's economic status will be impacted on a global stage. In order to grow, we need to be productive.
Does it make the United States of America more competitive in the G20 or less competitive? There is no question to that outcome. Less competitive.
China loves this kind of agreement. They know that the US and other countries will unilaterally disempower. So it's to their strategic advantage. What they do is they have a fossil fuel powered economy, over 80% fossil fuels, which they use to produce unreliable solar panels and wind turbines, which then they want us to mandate. And unfortunately, Joe Biden is playing right into their hand.
And of course, Bitcoiners are sounding the alarm, warning that spending will lead to more long-term issues, less productivity, less saving, and ultimately more inflation.
The Keynesian notion that growth at any cost is always a good thing, it's just an incredibly broken and flawed notion. We don't need top-line growth. We don't need higher prices. We don't need, quote unquote, more of everything. What we need is more for less, which is what deflation is.
All right, it is time for our weekly macro segment with Andy Edstrom, CFA and author of Why Buy Bitcoin. Andy, the big news last week was the July CPI data, which came in lower than recent CPI prints, but still elevated relative to history. So how has the market continued to digest this information?
Well, Natalie, it appears that investors have continued to view the most recent CPI data as a sign of relief. July CPI was 8.5%. which was lower than the 8.7% that had been forecast. And it was also lower than the prior month, which was 9.1%. Those are all year-on-year numbers. The actual month-over-month growth in CPI was 0. So, stock markets and risk assets have been up by a few percentage points in the last week, and it appears that investors are still viewing the inflation news as relatively positive.
Well, Andy, what do you think about the likelihood that the bottom is in for risk assets, the one we saw in mid-June? Is that behind us?
It's a great question, but it's a difficult one to answer, Natalie. Nobody rings the bell when the market bottoms, right? You never know in the moment whether it's a bottom, or even necessarily soon after whether it was a bottom. It really requires the passage of time to know for certain. We know that we've been in a challenging macroeconomic environment overall, and financial conditions have been tightening. So, the Fed is really walking this difficult line between reducing inflation and also maintaining full employment and not torpedoing the economy. Markets are forward-looking, so they try to anticipate what's going to happen in the future. And certainly risk assets are highly correlated with Fed policy. So, signs are positive, especially given the CPI data, the inflation data, which are kind of driving everything. It's too early to call a bottom, I would say. But I would say that if we get a continued positive trend in inflation, that is, if we continue to see lower and lower inflation numbers, that is going to increase my confidence that, in fact, we have already seen a bottom in risk asset prices.
All right, Andy, what are you focused on from here?
I'm still looking mostly at the same indicators and factors. Because inflation is so crucial to Fed policy, and because Fed policy is so crucial as a driver of asset prices, I'm looking at things that drive inflation as well as overall activity. So I'm still looking at industrial commodity prices, especially oil and copper. Those have indicated some relief. We'll see if those trends continue downward, which probably would be good for future indicators of inflation. And speaking of inflation, next week, August 26th, the Fed's preferred measure of inflation, that's PCE, will be announced. And so I'll be looking carefully at that number when we get it.
All right, thanks so much for joining us, Andy, and thank you so much for watching this week's edition of Hard Money. Our goal is to give you the latest headlines impacting Bitcoin and the global economy while bringing you original interviews straight from the biggest names in the space. I'm Natalie Brunell, and I'll see you next week.